Hello everyone, in this video I'm going to show you how we bought £480,000 worth of property, two side-by-side commercial units, 10,500 square feet. We paid £480,000 for it using none of our own money and no cash from an investor either, so I'm going to show you how we put that together. Okay, so the property itself we paid, or the two properties we paid £480,000 for. 10,500 square feet, so if you work that out, probably around 44 quid a square foot, something like that, which was a good price for the area. Having spoken to the planning department and our architect, we decided to go for planning for 21 units plus 2 retail units. Now, when we bought it for the 480, it had been a restaurant, a cafe, storage, offices, been numerous different things dotted around the relevant commercial units there. How did we acquire it for 480 using none of our own money? Well, an investor come on board, and the investor had unencumbered property, meaning he had a few assets without any mortgages on them. 480, we went to a bridging lender, and the bridging lender was happy to lend us 60% of this purchase price. I think if you work that out, that's £288,000. And he had two semi-commercial units, the investor that's come on board with us. And his two properties combined were worth around £380,000. One was worth about 200, the other about 180. And they were happy to lend 60% loan to value on those. And if you work that out, I think that's £228,000. Now, the bridging lender was happy to lend 60% here, 60% here, and the combined loan there, if we decided to take all that money, which we didn't, but it would be, I think, £516,000. Now, if you look at what we were paying here, 480, we could have, if we went for the total loan, we didn't need it all, but we could have done. They would have lent us £516,000 using these here. They had a first charge here. And of course, they would have had a first charge over these two properties that we were buying here. So I hope that makes sense. The lender could see that we had unencumbered assets from the directors and shareholders of the business. He owns 50% of the company, the gentleman who put his two properties up. That is his input. Our input is everything else. He's assisted us in acquiring. He's going to assist us in some of the financing availability, so we can use his income to borrow more money for the development, which I'm going to talk about in a minute. But that was essentially his input there, allowing the bridging lender to leverage against his assets. Now, we paid 480, it's a good price, but we've also got to take into consideration here, there was £13,500 of stamp duty. There's £2,500 there or thereabouts of legals. And there'd be a few other costs. There is also, having gone for planning, there's been around circa £10,000 in planning fees as well. So if you work that out and we'd have gone for the whole lot, we could have had 480 plus your 13.5, plus your 2.5, plus your 10. Now, and that works out at £506,000 there. Right. So, purchase price plus stamp duty plus legals plus planning fees, service fees, all that other good stuff, you're in for about £506,000. As you can see there, we could have raised the 516, we didn't. I think we got about 510 out of it in the end. So we acquired that, we paid for planning, stamp duty, legals, all that other good stuff using bridging finance, allowing the bridging company were very good and flexible, allowing us to borrow against his unencumbered assets because, well, why wouldn't they? It's safe investment for them, and we're a good bet. So Now, originally we were going to go for 25 to 26 residential units in here, but as I said, having spoken to the planning department, we've decided to go for 21 residential co-living units plus 2 retail units. We expect a GDV on that of around £2 million. So we paid, as I said before, we paid $480 for it. You had a lot of fees and whatever else. I think it worked out to what was it, £26,000 in fees. So we were up to £506,000. Now, I went to a different lender. We possibly could have stayed with the same one, but we decided to move, and that is touchwood going through in the next 4 weeks or so. We expect planning to be approved in the next 14 days, all being well. We've had terms from a lender who has offered us £560,000 on day one. We're in for 506 plus the interest on the loan. So there is at the moment around £25,000, £30,000 worth of interest on top of this figure here. So we're going to be up to around, these are round figures, I haven't got a completion statement on it, but let's say we're in for about 536 at the moment. On day one, the new lender is happy to lend us £560,000. So this 560 here will pay off the old bridging lender. This lender will have the security over our investor's capital, the shareholder of the company, the other guy who has put his property up as security. This lender will refinance those and take the first charges. And the lender has said that they're happy to fund £500,000 of the development in stage payments, so drawdown. So as and when we need that money, essentially there is a process to go through. This is a bit simplistic, but we will ring them, say we need further money, we need another tranche of money. They may send out a quantity surveyor to come and make sure everything's happening as it should be. They may not, depends. But we're there. Once all this is done, they've got interest on it. We'll be in for around £1.2 million. And we expect it to be worth around £2 million. Now, I always put contingencies on these things because things always go wrong. Nothing ever goes as well as it can. But as you can see, £2 million GDV. We're in for around 1.2 million. It will be a little bit more than that, just because I know it will. I've been in the game long enough to know. But as you can see, there's a nice margin there. And the acquisition of the buildings, in my opinion, is more... The point of this video was to show you how to acquire assets using none of your own money. I hope that shows you how you can utilise assets that already exists without mortgages on them, utilising your network of investors, because a lot of people don't know you can do things like this, and utilising debt to acquire more and more assets as you're in building phase, as you're in growth and expansion phase. Very often people leverage debt, and you don't have to do it the one way. There is no box there. You can think how you want to be creative and put deals together that no one else has ever done before. You can do that. There's no reason you can't, as long as it's within the bounds of the law. So yeah, nice margin, no money in for us. We've used the equity in our investors' property to be able to raise that capital. And all being well, we get a 2 million valuation. We'll probably sell this building once it's all done and complete. We'll probably lease the 21 units to probably a serviced provider, so not a care company as such, but a social housing company. And we'll probably lease these 2 retail units out, a cafe, maybe a food outlet, things like that. So it'll be a nice building for somebody. I hope you got something from that. Drop me a comment down below. If you've got any questions, just ask. More than happy to help you out.